Definition of an option. So what is an equity option? An equity option is a contract which gives its holder the right, but not the obligation, to buy or sell 100 shares of a particular stock at a specified price at any time on or before a given date. The holder of an equity option, often referred to as the buyer, is the person who purchased the contract and holds the position in a brokerage account. The particular stock the option holder has the right to buy or sell is called the underlying stock, and it is the stock that largely determines the option's value at any point in time. Breaking down the definition. Let's break down this definition and look at the 6 pieces that make up the terms of all equity option contracts. Remember, all contracts have terms, but with equity options, these terms are standardized. According to the terms of an option contract, the holder is purchasing the right, but not the obligation, to buy or sell. This is determined by the type of option being purchased, and there are only 2 types, calls and puts. That's it. Calls give their holders the right to buy the underlying stock, and puts give their holders the right to sell the underlying stock. There are a wide range of strategies available to option investors, but each will be comprised of all calls, all puts, or a combination of calls and puts. Some might even include a stock position. These are the building blocks which investors can tailor strategies that offer acceptable profit potential balanced with their own tolerance for risk. 100 shares. Each equity option gives its holder the right to buy or sell generally 100 shares of a particular stock. These 100 shares represent an option's standardized unit of trade of a particular stock. This is the underlying stock that an option holder has the right to buy or sell and on which the option's value is largely based. Not all stocks traded in the U.S. have equity options, but a large number of them do. You must select an underlying stock that is currently available for trading on one or more option exchanges at a specified price. This is the price at which the option holder has the right to buy or sell underlying shares, expressed on a per-share basis. It's commonly called the strike price, but it is also known as the exercise price. For options on any particular underlying stock, available strike prices are determined by the option exchanges on which those options are listed for trading. You must select a strike price that is currently available. At any time on or before, this term indicates the option's style, or the period during which the holder can actually buy or sell 100 shares of the underlying stock if he or she chooses to do so. A given date. Like most kinds of contracts, equity options expire, and every option has an expiration date. After its expiration date, an option, along with the holder's right to buy or sell the underlying stock, ceases to exist. You will generally see or hear an option specified by the expiration month in which its expiration date occurs.